Hey, what's going on, savers and investors? As always, I hope you're having a fantastic day. After all, it's Friday, and who doesn't love the weekend? If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about a topic that I've actually been asked quite a bit since posting my most recent videos about the stock market crash, and that is whether or not I'm personally still investing in stocks right now and buying up stocks, or if I'm waiting for the market to somewhat bottom out in the coming weeks or months. If at any point in today's video you're enjoying the content, then make sure to smash the like button. I think most viewers here are really enjoying these stock market news style videos because my last video got upwards of 400 likes, so let's try to hit 500 likes on this video. Now obviously I'm not going to be covering my entire rationale around the stock market crash once again in this video because we've already covered this quite extensively in previous content, but the gist of analysis and thought process here is that yeah, we're most likely going to continue seeing the stock market drop off in the coming months, and this is really going to be impacted by the financial scope of a business slowdown and what impact this has on the overall economy, which could potentially lead to a bear market for the coming 6 months, a year, who really knows at this point. With that said though, I did mention in those previous videos that the main indicators determining whether or not we would see a prolonged bear market would really be the number of medical cases, as well as whether or not businesses are going to be back up and running in the short to medium term, and subsequently having more workers back in their workplace and stimulating the economy again. As it currently stands, there is no news whatsoever about businesses being back up and running in the short term. In Canada, basically nationwide, all companies are required to be closed until minimum May 1st, with some provinces like Quebec even warning that depending on how the medical situation pans out, this might be extended into June. And down in the United States, talks of having businesses up and running by Easter. Personally, I think that this is cutting it really short, and I know for a fact some states have even officially extended this to May 1st, not to mention the fact that medical cases in North America are really showing no signs of concrete slowdown in North America as a whole. This now brings up the valid concern of what types of economic impacts will this have long term on our economy as a whole, because only a couple weeks back we didn't necessarily have the full scope of financial impacts that this whole medical situation would have, resulting from businesses being shut down for an extended period of time. But now that we know that businesses are all going to be shut down for minimum 1 month across all of North America, it's basically quite evident that Q1 and Q2 numbers for revenues are going to be highly impacted. In fact, if we take a look at the predictions Goldman Sachs has recently just released, they're estimating a 9% hit in Q1 and a staggering 34% hit in Q2 to the overall American GDP, which is entirely unprecedented. I mean, this is something we've never seen. If you take a look at previous quarters during economic slowdowns, it is not even comparable to what we're experiencing right now. If you actually think about it though, this makes perfect sense from a GDP standpoint, because unlike past recessions where there was a gradual economic slowdown over multiple years, this current situation we're living through right now is an immediate, somewhat unwanted halt of all business operations across North America, especially for companies operating in travel, restaurants, tourism, and hotels. So although these numbers are staggering from a GDP standpoint, and there's no question whatsoever that this will inevitably have a direct and indirect multiple year impact on the economy, I'm personally still staying firm on the prediction I made in past videos, stating that the GDP numbers as well as stock market valuations will rebound quicker than in past recessions. Even though millions of individuals are currently out of work and unemployment rates have shot through the roof in the past week or so, this really shouldn't come as a surprise because businesses are required to be shut down temporarily, so it makes no fiscal sense for businesses to maintain a large payroll, driving up costs. But the moment we have the green light to be back up and running, businesses are going to be bringing back those temporary layoffs, which is going to stimulate the economy again once people are back out and spending money. Now currently, where does the market stand on a point basis? Well, this past trading week was definitely somewhat of a relief from the beating that we've had over the past month or so, but this was most likely propped up from the various stimulus packages offered in Canada and the United States. The Dow opened opened on Monday at 21,678 points, and now early day Friday, it is at 21,200, which is up 2,700 points roughly from the 18,500 point Dow low on March 23rd. This leaves many investors now questioning where the market will be heading in April and May, which to that, once again, no one really knows, but it's safe to assume that most likely, especially if market negativity starts really soaring again in the media, we'll continue seeing prices retreat down towards possibly even that 18,000 point level again, which was a 4-year low for the Dow. But we're just gonna have to wait and see how this medical situation and business closure situations play out in the short to medium term. So with that covered, is it or is it not a good time to be buying up stocks? Well, before we answer that question, if you hadn't had the time yet to check out the ultimate personal finance spreadsheet I made, which includes an automatic dividend tracking and accurate cost basis calculating stock market spreadsheet, then check out the link down in the description. I've had some great feedback already on the spreadsheet, and I think it could really benefit all my viewers with keeping track of your overall finances and your stock market portfolio. To answer that question though of whether or not I am buying stocks and other financial securities amidst this current market crash, well, if you've been watching my videos for a while, I think you know the answer to this already, and that is that yes, I am buying stocks amidst this financial crash. To be fair though, I have been purchasing stocks throughout the entirety of this stock market crash, but I actually haven't really picked up any new positions over this past trading week, which has been trending relatively green, because I do think we are going to continue seeing prices drop over the next coming weeks and months. So for this reason, I didn't really pick up any new positions. However, currently the Dow is sitting in the low 20,000 range, which is the equivalent point range of mid-March, where I was buying up positions and dollar cost averaging my way down to that 18,000 point range. So whether or not you were buying up stocks this past week, 2 or 3 weeks ago, I would tend to say that nonetheless, you're going to be getting a good deal on these positions, granted that you did proper research into these companies that you're purchasing and fully understand from a fundamental basis that these companies will have the capacity to weather through this current economic climate, as well as be thriving in 5 to 10 years from now. Criteria to look for when investing in companies that will have the financial capacity to weather through this storm are a strong balance sheet with high assets and cash in the bank in order to allow them to weather through this period, as well as even better, potentially pick up some other smaller companies that are still good but don't necessarily have the reserves to weather through this storm and stay afloat here. Other things you want to look for are outstanding debt balances, as well as revenue growth and net income growth. Obviously, businesses essentially across the board are going to have truncated revenues and net income for both Q1 and Q2 at a minimum. But what you need to ask yourself as an investor is whether or not you're investing in companies that have a strong enough balance sheet to get through this period, and then once the economy is propped back up again and people are out spending money, is this a company that's going to be thriving? If you're investing in companies that are highly leveraged and really have no cash in the bank or assets to potentially live off of during this period of slowed down growth of revenues and net income, this could be a much riskier investment. Again though, I cannot stress enough how important it is that you do proper analysis of the companies you're investing in before investing in those companies, instead of just investing based on emotion and current stock price. Always remember that a current stock market price is simply a snapshot in time of market sentiment towards that stock, and this can change in the blink of an eye, which tells us that the stock market price when you open up your brokerage is not necessarily reflective of the true value of that stock. If from doing your own analysis of a stock, you fundamentally believe that this company's stock price is severely undervalued, then regardless of whether or not you bought the stock this week or 2 weeks ago, newsflash, right now all the markets are down easily 15 to 20% for basically all stocks across the board, where you're automatically buying into equity, which will be materialized once the economy is stimulated again and businesses are back up and running. I've mentioned this before, but dollar cost averaging and buying into a stock at multiple different price points over a given period of time is a great way to average out your book cost and not overextend yourself into a company at one single price point, which is definitely a huge advantage, especially especially right now as markets are extremely volatile. What I would suggest is identify the companies you want to invest in and then set price points for which you want to purchase into that stock so that when the price reaches that price point, you're able to go ahead and purchase a portion of that stock with the funds that you have on the sideline in reserve, and then spread that out over a period of time so that, for example, if you have $5,000, you're deploying $1,000 on a given basis so that you can then average out your book cost. And even though I personally wasn't out buying stocks this past week or so because markets were trending green, and I personally think that there's still a couple weeks of market tumbling ahead of us, I'm never trying to accurately time the market bottom to the T, because this is pretty much what's known as greed, and 99% of the time people are going to miss out on this most opportune time anyway. So right now stocks are all pretty much undervalued across the board, and you can still get in at a 15 to even 50% discount on really great companies that will be thriving in the next 5 to 10 years. So trying to time the market bottom and getting a 5% variance on your stock price, to me, is really not worth it. Now, I do want to mention a couple things before wrapping up this video, because some people have reached out to me asking whether or not they should be capitalizing on the stock market being down right now, or if they should continue sticking to their financial plan of paying off debt and then building their emergency fund. And personally, I would 100% tend to lean towards sticking to that financial plan of, first of all, always paying off your debt, especially if it's high interest consumer debt of 6% and up, and then continuing to build that emergency fund, because more than ever right now we're seeing this firsthand. People are going to be dipping into their reserve funds and dipping into their savings. If you don't have an emergency fund, this is a really detrimental situation to be in during a market downturn. At the end of the day, there's a reason why I've been speaking about this whole emergency fund thing for the past 2 years or so on my channel. Even though it might be repetitive or boring to hear, we're experiencing firsthand why it's critical that you have at least 3 to 6 months of expenses saved up and having that in an emergency fund. If, for example, you only had a stock market portfolio to rely on right now, and that was your only source of liquid cash, and you had to sell off some of your positions at a 15, 30, 40% loss, you're materializing huge losses for no given reason if you were to just hold on to those, and eventually they would go back up in value. So it's really critical that you have an emergency fund in place. And then yes, I would 100% recommend that you pay off any high interest consumer debt. Number one, that's the most important thing, because there's a 100% chance that you're gonna have to pay that interest regardless of any of your other investments, which can be much more difficult to achieve a 20% gain than a 20% interest rate on a credit card, for example. All right, so that pretty well wraps up today's video. I really hope you enjoyed the content. If you did, make sure to smash the like button and subscribe to the channel where we talk about stock market news and other forms of stock market investing. If you want to learn more about investing in the stock market and picking securities, make sure to check out one of the 2 videos that I'm overlaying right here. And on that note, thanks a lot for watching. I'll see you in the next one.